Hey everybody, welcome back to the Optometry Money Podcast, where we're helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I'm your host, Evon Mendrin, certified financial planner and owner of Optometry Wealth Advisors, an independent financial planning firm just for optometrists nationwide. And thank you so much for listening. Really appreciate your time and energy. And if this is your first time listening, welcome to the podcast. Today's episode, I have a fantastic guest, Matt Ruttenberg, a part owner of Life Inc. Retirement Services, and we dive into the retirement plan options available to private practice owners. If you're thinking about what is the right retirement plan option available to you to implement in your business, if you're looking at the plan you have and wondering whether it needs to be adjusted or not, what's the right solution for you, we dive into that. We talk about different IRA-based plans like SEP IRAs, simple IRAs. We talk about 401k plans and the different features involved in that and some questions to ask to figure out which is the right solution to you. We also talk about some of the updates that came with the Secure Act 2.0 that came at the end of last year. We talk about the enhanced tax credits that come with starting a new retirement plan. So everything you need to know about getting started with retirement plans. And Matt is a third-party administrator. He is a true specialist when it comes to retirement qualified plans in your practice. And he brings so much experience and expertise and insights to the conversation. So I had a lot of fun. And I'll throw all of the information and links and his information in the show notes. I'll also throw a link to my podcast episode on the Secure Act 2.0. So if you want to go back and listen a little bit more about that, and you can find the show notes by scrolling down in whatever app you're in, or by going to the Education Hub on my website, www.optometrywealth.com. And while you're there, check out all the other podcast episodes, resources, articles we put together. And you can also feel free to schedule a no-commitment introductory call, and we can talk about whatever's on your mind financially, and we can talk about how we serve optometrists all over the country, master their cash flow, mitigate their taxes, and plan more proactively around their finances. So without further ado, here is my conversation with Matt Ruttenberg. And welcome back to the Optometry Money Podcast. I am your host, Evon Mendrin. And on today's episode, I want to have a conversation about different retirement plan options available to you as a practice owner. And maybe you've cold started a practice, maybe you've purchased a practice, profits are increasing, cash flow is improving, and you've got enough liquidity in your life. And now you're starting to think about, okay, where can I start to invest some dollars and also pull some tax planning levers? Where can I start doing that? And for a lot of you, for practice owners, a natural next step is a retirement plan in the practice. Or maybe you're an established practice owner and you're sort of reevaluating what options are available to you. And even if you are not a practice owner, I think a conversation like this will help you to just better understand the benefits available to you with your employer. So I wanted to have a conversation about that today and to save you, the listener, from yet another solo episode and just hearing me go on and on and on my own. I wanted to bring in a true expert, someone who knows these things inside and out. So I'm excited to welcome to the podcast Matt Ruttenberg, owner of Life Inc. Retirement Services. Matt, thanks so much for coming on.
Thanks, Evon. Appreciate it.
Yeah, I'm excited to chat with you today. And before we dive into all of that fun stuff, just give us a little bit of a background. Tell us a little bit about your company, what you do, what your background is there.
Yeah, absolutely. Yeah. So I'm a part owner of Life Inc. Retirement Services, and we're a 401k administration company. I've been associated with this company for, I think, 4 years or something like that. Prior to that, I've been in the finance industry for 18 years now, I think, okay. Maybe 19 years. And I was a financial planner, kind of went up through the different ranks, if you will, kind of worked with other companies and then owned my own practice. I wanted to be I really enjoyed working with business owners, and I wanted to be a little bit more of a specialist in that one area. And I had clients who owned businesses, and I did the 401ks for them. I did their individual business stuff, or the individual planning as well. But I really wanted to work with planners and focus on the 401k. And so I ended up selling my practice and merged my 401k business with this company. I want to say it's about 4 years ago now. And yeah, so that's kind of been the structure going through. I just realized how long I've been in the industry, and that is aging me a little bit. So, but yeah, and so I've kind of touched all corners of the industry, let's put it that way,
Yeah.
and I've kind of settled in the 401k business.
Well, as someone who works with these practice owners, I can definitely appreciate the need for a specialist with these retirement plans, because there are a lot of details, a lot of features and levers to pull, and a lot of ways it can go wrong
Sure.
if not done according to what's needed. So can definitely appreciate that. And well, let's sort of dive into the topic here. I mean, what if
Sure.
you're talking with a practice owner for the first time? They've never had a plan before, a retirement plan, and they're thinking, okay, what are the options available to them? What are the options available to a practice owner?
Yeah, and let's start with the group side of things. And obviously, when you're starting any business, your first priority is to reinvest in your company, right? You don't
Yes.
really have too much. You're not paying yourself too much. You're putting the money towards the employee pool, with payroll, and you're reinvesting in your own company. Then at some point, you start saying either you want to offer it to your employees for them, or you want to do this for yourself for tax planning purposes. And it really, there's basically in the group area, in the group arena, meaning you have full-time employees, there's two kind of categories. One is the IRA category, and then the other one is the 401k category. And the IRA category is one, there's, SEP IRA. A lot of people associate that with solo practices or a solo entrepreneur. But you can offer that to your employees. That ends up being very expensive, which we'll touch on. But and then there's the simple IRA, and the term simple is absolutely what it means. It's very simple. The investments are simple to choose from. The structure is simple. You only have a few options to choose from. No administration is required, so the costs are simple. And it's basically a turnkey, like, let's get things started. Technically, you can have a lot of employees inside of there. I find it good for maybe just a few, and more not because the options are less available inside of it. It's more of the administration side of it for the business owner, or the maybe the HR rep, whoever's managing the actual plan, like who's sending the money to the custodian, you're probably using QuickBooks, for your payroll. So you're doing a lot of manual transmissions of it. And once you get it closer to like 10 employees, then you're like, okay, let's start looking at more the 401k, because there's more integration with the record keeper and the custodian, and so on and so forth with the payroll. So IRA means it's easy. There's no administrators like myself. We are not technically needed in that venue. And then the 401k side of it, that's when first of all, the contributions are much larger. The options as far as creating and molding the plan are much greater. And that's when you get into, you can add profit sharing, you can add defined benefit plans on top of it. And those are kind of like the basics, but inside of the 401k part of it, that's also split between two different categories inside of the 401k. You have the safe harbor 401k, and then you have the traditional 401ks. And the safe harbors are, the best way to explain this, they are pre-approved matching investing schedules that the IRS deems as fair to your employees. And when they deem those as fair, they check off that box, and now the employer can max out their own contributions as an employee of the plan. On the other side of that is the traditional 401k, and the traditional 401k is more, you mold it to the matching investing schedule, how it fits your budget, or how you want to maybe spread out the match a little bit so it's a little bit cheaper for you, or spread out the vesting schedule so you can have them with you longer in order to retain them and before they can walk away with the match or something like that. So there's some downsides to the traditional, because that's when these annual tests come into play that you hear about, and
Yeah.
the employer is going to be held to a certain amount of money they can put into it if they don't, quote unquote, pass those tests.
Right. So let's. I want to back up and just talk a little bit more about these each ones. And so you've got your IRA based plans, which is sort of like a web of IRAs connected to this business, essentially
Yep.
through the plan. And then you've got your 401k based plans. The SEP IRA, number one, is something that the employees themselves cannot contribute to. It's really just the employer. Can you talk a little bit more about how that functions?
Yeah. So to break down contributions in general to any 401k or IRA, there's two kinds of contributions. There's employee contributions and there's employer contributions. The employee contribution is what comes through payroll, right? That comes out of your paycheck, and you earmark usually a percentage of how much goes into that. And the employer contribution is what comes out of the corporate account, and that's generally like profit sharing in the 401k side of it. But SEP IRAs are always employer contributions. There is no such thing as an employee contribution in a SEP IRA. So if there's no employee contributions, employees cannot contribute. The only thing that's going to be coming out of is that what comes out of the corporate account is it's historically always been pre-tax. They change that. And that's usually done as a percentage of your wages, basically. So for example, let's just say you're giving yourself 10% of what you're paying yourself. You have to give them 10% of what you pay them. And that maximum can be 25%. So you can go up to 25%. Let's say if you're paying yourself $100,000, you can put in $25,000 into the plan. And you have to give 25% of whatever you're paying your employees as well.
Got it. So you mentioned profit sharing earlier. This is sort of like a light version of profit sharing. It's
Absolutely.
Essentially you're sharing the profits, the extra cash flow of the business spread out among everybody.
And it has a maximum of $66,000. It has the same maximum as a 401k. It's just you're held to certain income limits inside of that too.
Got it. Okay. So the SEP IRA is employer dollars only. The simple IRA is different. It allows for both the employees to put money in as well as some dollars from the employer. Can you talk a little bit more about the simple IRA?
Yeah. So the simple IRA is, like you just mentioned, mostly employee contributions, right? So it comes out, they choose the percentage, and then the employer portion of that is only going to be the match. So the match is considered employer contributions along with profit sharing or something, but there is no profit sharing inside of the simple IRA. So it's only the employee contribution plus the whatever the match is deemed. There's a few different options to choose from.
Got it. Yeah. So it's pretty, like you said, it's pretty straightforward. It's simple. It allows your employees to contribute to something on a tax deferred basis, or now, as you'll talk about later, potentially on a Roth basis. It's going to increase the amount you can put in above and beyond just an individual retirement account in IRA. And the maximum is about $15,000 this year, right? In 2020,
15.5. Yep.
15.5 for this year. A little bump if you're 50 or older. So it's going to allow your employees to contribute, and there's a bit of a match. There's some dollars that you, as the employer, the practice owner, is going to also contribute to the plan for your employees. So it gives a benefit there if employees are asking for it, right? It's a nice benefit there.
Yep.
So if you go beyond that, let's talk a little bit more about the 401k. How does the 401k work between employees and employers contributing? What's the differences there?
Yeah, and obviously, so contribution limits. Let's just start there real quick. In 2023, it's 22,500. So there's a big difference there between the simple versus the 401k. But it's similar as far as, the standard 401k is the employee contribution, what they choose, and then you have the match or the contribution. And if you're using the safe harbor, there's some turnkey options, and then if you're using traditional, you can mold that however you need. The employer contributions are, again, the match, but you can also add profit sharing on top of the 401k. So think of it as like a layered effect. Most 401ks have this basic profit sharing option, a discretionary profit sharing from year to year. You can, if you have a great year, you can say, okay, let's get rid of some of these taxes. I have $50,000 to burn through. I don't want to give it to the IRS, so I'd rather give it to my employees. And then we do the calculations. There's multiple ways, which we will get into at a future date. But to calculate profit sharing and how to maximize it for yourself, but it's a discretionary annual contribution that you can choose to turn on or turn off whenever you need to.
Got it. Yeah, it's not something you're necessarily locked into each and every year. And as you mentioned, that's for me, it's a conversation between the administrator, which we'll talk about who that is and what that individual does, the tax professional, and the client to say, okay, what is available at the end of the year for profit sharing? How much would need to go in each employee's accounts? And what would that do from a tax perspective? Let's project out taxes and say, okay, does that make sense? Versus just simply adding to a taxable investment account or something else. So there's a conversation for that at the end of the year. What else should optometrists know about? So there's definitely an increase in the amount that you can put in. There's more flexibility, like all the different features you talked about in terms of the match, depending on the type it is. And I guess maybe you can talk a little bit more about the differences between safe harbor and a traditional plan. You talked about with a safe harbor plan, which I think a lot of optometrists will have heard of. That's going to be commonly said among practice owners. It helps to avoid some of the testing required, but there's sort of a off-the-shelf match calculation. Can you talk about the differences between the two a little bit more and the different types of safe harbor plans?
Yeah, and before we dive in, I think we should mention maybe some deadlines too, real quick on that. Yeah. And that's just a quick. But the employee contributions are always due. It's just called end of year, 12/31. Employee contributions are due by 12/31. Obviously, if you have your payroll is a mid-cycle or something, they'll give you some leeway on that. But employer contributions, and historically, prior to 2019, this wasn't. It was 12/31 in the 401k world as well. But now it's the day you file, including extensions. So that puts you all the way out to September, October, depending on the structure you have, and that's for the prior year. So technically, you could go all the way to September and still get a tax deduction as long as you filed an extension. That's the biggest piece. You have to file an extension in order to delay those. So usually, it's like your taxes are in mid prep. Your CPA comes to you and says, "This is your tax bill." And then you come to me and we start having these conversations on how do we maximize that. So, but coming back to the safe harbor, there's about 4 different options. Some of them folks don't really talk about. There's the QACA, which is Qualified Automatic Contribution Arrangement. There's the standard. There's then there's just a contribution instead of a match. It's called a non-elective contribution. Which I'll explain later why we would want to use something like that. Basically, you're giving a contribution to everybody who's eligible instead of those who participate. Those are 2 different terms, very important. A match is to those who participate. A contribution are to those who qualify. That's it. And then there's basically, you can make any of these richer. You can make them more rich. On the 4th option, you can make them more robust. All these different turnkey options in the safe harbor world, they're minimums, and you can kind of mold them and say, I want a little bit of this one and a little bit of that one. A lot of people don't realize that. So there's a lot more to customizing a 401k plan than most realized. Sometimes it's let's go to the one online. What's maybe the payroll provider? Here's your options. Check which one you want. Those are called prototype plan documents. But there's so many things you can customize and mold to fit your business based on your goals that a lot don't realize using a custom plan document.
Yeah, and when you look at these laws around these retirement accounts, ultimately they're there to protect the employees, right? They're
100%.
What they don't want you to do as a practice owner is simply just open the plan so that you can benefit and employees don't get much out of it. Yeah. Ultimately, they're there to protect the employees and make sure that the employees are getting something out of the plan. You can still benefit from it most simply because you have the most cash flow and you have the most flexibility to tinker with it and to adjust the features of the plan. But
Yeah.
that's sort of behind the scenes of why there's testing, why there's a safe harbor plan versus traditional. If you're going to utilize the plan the most as a practice owner, they want to make sure that the employees are getting some minimum benefit from it.
Right.
And your thought earlier about the deadlines, if you're a practice owner or an employee and you're trying to target a certain amount you want to get into the plan for your employee amount up to the maximum, just look at how many pay periods are left, making sure you're on track for that, because that's something that's got to get through by final pay stub end of the year, right? So that's something you don't have really
100%.
much flexibility on. So take a look at that. And you talked about different features in terms of vesting and who's eligible. And that's another thing about the simple IRA. And one thing I'll ask you next is to sort of how to decide between these different plans. But that's another thing about the simple IRA is that there is a pretty rigid requirement for who's eligible for the plan, who is allowed to get in it, who you have to contribute to. For the 401k, there's more flexibility on how to define who's eligible, vesting schedules. There's just a lot more flexibility on that I think practice owners can benefit from, depending on what their employee, the amount of employees they have, how often they're hiring and seeing employees leave. So, a lot of this is going to come down to what are your specific needs as a practice owner, and to sort of aid in that transition here. I guess I have two questions for you, Matt. A lot of the conversations that I see when practice owners are asking each other about which plan to use, when they're asking me about which plan to use, a lot of the conversation steers towards, well, 401ks tend to be more costly and complicated than simple IRAs. So a lot of suggestions tend to be just open a simple IRA and go with that. Mm-hmm. But can you talk to us about what questions these owners should be asking to help them decide which plan is the right one for them?
Sure.
And then secondly, if we can remember the question, what is involved in administering the 401k plan? Like what different roles need to be involved? Because you mentioned one should have an administrator, the simple IRA doesn't. So let's start with what questions should a practice owner ask to figure out, okay, what is the right plan for them?
Sure. Yeah. And so when we have, obviously I rattle off a bunch of different options, and there's even a few more options in the solo space too. And a lot of this, when we speak to a new client and they don't know where to begin, there's always two questions that we ask. We start the conversation off with, one, why do you want to do this? Like, what's your priority? What is it you as an employee of your own company? Are you trying to stockpile for your own retirement? Is this a tax play for you? Or is this pure the other part of that question is, or is this to, sorry, I'm having a little, or the second question is, is this purely to recruit and retain high quality employees? Because not only are you in competition against your competitors for business, employees are a huge part of your business. So yes. Is that the other part of it, right? And if it's purely for your employees, right? There's two ways to look at it. It's basically, are we going for a lowest cost option, or do you want to mold this thing and drag out the recruiting and the retention with a vesting schedule as long as you possibly can? So to sum up the first question, we say, all right, now how much do you want to save as the employer? Okay. And if they say, I'm not going to save anything because I'm still trying to reinvest into my company, this is just the next part of reinvesting in my company, right? Even though it's not for me, then we'll tend to lean towards the traditional 401k in that instance. Because yes, there are additional costs involved in the 401k, in the traditional, the administration costs. But with the tax credits, which we'll talk about here, we're creating net zero 401k plans right now with these new tax credits that came out in 2023.
Net zero meaning net zero cost.
Net zero cost on the match, net zero cost on the administration costs. It's crazy 5-digit tax credits what's coming out. So and the reason why we do the traditional because realistically, they're going to fail the annual testing, which is fine. There's no like fee, there's no penalty. It's just all it is deciphers how much can you put in as an employer, but also your highly compensated employees too, which we do have. Highly compensated employees are those who make over $150,000. Basically, what it means, they're looked at in the annual testing side of things like the owner. That's the best way to explain it. So if you have those,
it would be the owner, as well as those other employees. It's probably going to be associate doctors. If you have associate doctors
exactly
meeting that income threshold, those associate optometrists are going to be a part of that.
Yeah, we see that a lot. There's a few, your spouse is always, even if you pay them, $10 for the year, they're still considered highly compensated employees. So your children, if they're kids, there's a lot of tax plays involved in getting your children on board. When I say children, you're minors, but also even if they're adults, they come into that play. But so if you fail, they fail. If you fail the test, they fail, and they're going to be limited to how much. So we have to think about that too. But going back to why we choose the traditional 401k, it's because you can make this match drawn out as much as you want, meaning you can say, I want 25% on 6 or 25% on 5. So they have to put in 5% of their own, the employee has to put in 5% of their own money, and then 25%, you only have to put in at 1.25%. But at the same time, I mean, can you say, I'm going to give you 25% quote unquote guaranteed return on any money? You can't say that anywhere. Right. So that's still a good quality match to do that. We do that a lot to start off. And then the other side of that is the vesting schedule. You can go out as five years. So as long as it's a graduating scale, so 20%, 0% in the first year, 20, 40. And the vesting schedule is basically how much money can your employees walk away with if they were to leave your company.
So if they leave the practice's dollars.
The match.
Not the employees' own dollars, but the practice's dollars,
yeah. Yes. Their money is their money, obviously. Right. It's that vesting schedule on what you gave them, whether it's a contribution, whether it's a match, depending on the year. So when you do that, realistically, the owner and the highly compensated employees are not going to pass those tests. And when you fail those tests, let me rephrase that. In order to pass, the employer is only allowed to put in 2% more than what the average employee is putting in, right? So if everyone else is putting even the 0%, if they're eligible and it's 0, that counts into that average. And if they're all putting in 3 on average, you're only allowed to put in 5. So if you're paying yourself $100,000 for the year, you're only allowed to put in $5,000 as an employee of the company. So
got it.
That's why we say, if you don't really care, and this is purely for the employees, this is a great way to start. And then they have all the options. You can get in with the simple though, obviously if they want to put in, let's say I want to put in $10,000 a year, or I want to put in $15,000 a year into this plan, then we'll lean towards the simple IRA. But all the simple IRA vesting schedule requirements, they're always instant vesting.
Right.
So the money you give them as a match inside of a simple IRA, they can walk out the next day and take it with them.
Yeah. And to go back, I guess if you're opening the plan for the benefit of the employees, basically what you're thinking, okay, well, how large of a benefit is this? Simply to have just have something there in order to say that you have a plan and go for that cheapest, lowest cost option, or do you want to extend the features out to incentivize them to add more to the plan, to stick around longer with a longer vesting schedule? So these are features you can build in to incentivize them to participate more and to stay longer, which recruit and retain is a part of that.
Absolutely. And just even go back to that, you don't have to have any match inside of a traditional 401k if you don't want to. It's just having that payroll deduction can be very important for your employees, because it's like it's a psychological barrier to have it come out of your checking account versus your paycheck, right? So having that alone is sometimes even better.
Yeah, interesting. And And what if they're going with that first option? What if their priority is really, okay, I as a practice owner want to really start to add dollars into these plans. How does that factor into the decision?
Yeah, and that's more often than not.
Yeah, I would agree.
It's safe harbor 401k.
Yeah.
And that is usually, I'd say 7 out of 10 folks who contact us are saying, this is why I'm doing this, and or taxes, right? In some way or another. And then you go safe harbor. And there's different kinds of safe harbors, obviously, and there's different reasonings, and we'll talk about this in another episode, but how to maximize all these different plans. So, you get into the safe harbor, you get into the profit sharing, and adding even more above and beyond that. But the safe harbor, out of those three out of those four options I mentioned before have an instant vesting schedule, just like the simple IRA. Okay. The one which is the QACA, Qualified Automatic Contribution Arrangement, has a 2-year cliff vest. So cliff means if they walk before the first 2 years is up of employment, then they get nothing. After 2 years, they get all of the match. And there's different ways to, even inside of a 401k, the safe harbor 401k, the turnkey options I said is the match and the vesting schedule, basically. That's it. Beyond that, you can even stretch out your eligibility. So eligibility is a little bit different. The eligibility means how long do they have to be with you as an employee to even have the plan offered to them. And you can go out as far as a year on that. A lot of people, it's 90 days. They have this 90-day period where they're testing them out, making sure they're qualified and everyone's happy with each other. But you can push this out, and we do this a lot, push it out to a year. So you have to be with the company for a year before they get access to the plan. And then you can even do semi-annual enrollment periods. Often it's monthly or quarterly, but you can push it to 6 months. So if you were hiring within that, right after that one, you could have them with the company for a year and a half before you have to offer them anything.
Interesting.
And this has to do with, this is really good for companies that have a lot of turnover, industries that have a lot of turnover, but two, it helps with cash flow, because even though they're vested, you're still putting that money in their plan, even though they're not vested, if they're not vested, you're still giving them that match.
Yeah.
Right. It's still going into, even though it's not theirs technically yet, it still has to go into it. And you have to think that through and say, okay, well, what's my cash flow? This will minimize it if you stretch out that eligibility a little bit more.
Right. They don't have a right to it yet, but it's still going to impact your cash flow each pay period. It's
100%.
still going to be segregated out to that account. And so when would they realistically want to choose a simple IRA versus a 401k? Because I've thought about the simple IRA really as my own thoughts about it are just it's a stepping stone. It shouldn't be thought of as a long-term solution. It should be thought of more as a stepping stone until, at a minimum, you feel like you're ready for the 401k. But in your mind, what have you seen that would lead you to go to a simple IRA versus the 401k?
And I think about this all the time too, because I say, what is the main purpose of the simple? And honestly, it's prior to the Secure 2.0 Act, which we'll talk about here in a little bit. There wasn't too many scenarios where I liked it, because it was only pre-tax. There was no Roth option, and Roth is super important in the overall planning, as you know. So, and the contributions were less, and so you had to fit in this small window of, I'm not going to max out my 401k as an owner. I need to get something in place. It's usually like, let's get it going quick. A lot of times it's the CPAs or the planners who are helping them and understand those priorities and the goals. And it's definitely, you don't need the administration. It's one less party involved. So it's super easy. But now there is work involved in maintaining the simple IRA, right? Absolutely.
There's not nothing involved. If things go wrong, you're the one responsible as a practice owner to fix it. You just don't need to hire another administrator to help with that. Yeah,
the administrator is reducing a level of liability for you, for sure. And if you don't have that, you are self-administering. And there's we have this problem quite a bit where the money doesn't get sent.
Yes.
And that is such a problem, where you have to send the money. That you, as an owner of of the business, you always have a level of liability. It's just simply choosing who you're working with is
Yeah.
a level of liability. And then how often are you sending the money? You're withholding it out of the paycheck, but you better hit submit button to send that money within a timely 30-day period. So, which is your employees' contributions. So, and then post Secure 2.0, now the Roth is becoming available inside of a simple, which is phenomenal. I never understood why they wouldn't. But at the same time, the tax credits also just went through the roof. So they tripled, quadrupled tax credits. So um, which offsets the administration costs for at least the first 3 years. So it's kind of more of, are you okay starting here and then moving here later, or do you
Yeah.
just want to set it up the way you want it now so you don't have to worry about it? And there's so many things that you have to do as a business owner. The administration, as long as you have a good administrator and you're not DIYing it, um, you know, the IRA, just for example, something little that people don't realize, the IRS wants you to benchmark every 3 years, meaning shop your record keeper, shop your custodian where the money's being held. And it's kind of this soft rule, but if you're not doing it and they come back and say why your employees paying all these fees, they've made examples of folks that they had to pay back the fees to their employees' accounts.
Wow.
It's a pretty hefty fine. So it's there. There's a lot to do with it, but yeah, I think about that all the time. When do you say the simple makes sense? And it's a very small percentage, I think, when it comes to that.
Stepping stone. Practice owner. Think about it as
Yeah.
a stepping stone. This is not a long-term solution. I've seen practices who I know have been in the simple IRA for far too long. Your cash flow is going to get to a point where you're just going to get more benefit out of the higher contribution amounts and the other layers that we'll talk about. This is a tease. In our next conversation, next week's podcast episode, we'll talk about how to layer on top of these features and get the most out of your retirement plan in the practice. But your personal cash flow is going to get to a point where you're going to benefit from these 401k plans eventually. It's going to happen. And yes, there's extra costs. You need to hire some additional people, which I'll ask you about in a second who that is. But the benefits of that additional investment, that additional tax planning will outweigh that over time. So
Yeah.
just keep that in mind. Simple IRA at best is a stepping stone, not a long-term solution. And let's talk more about the 401k. Who are the people involved? Like who are the actual parties that need to be involved in this plan?
Yeah, and so there's always three parties involved in a 401k, even in the solo 401k. So if you don't have employees, there's always three roles. Okay, sometimes you're DIYing it, sometimes you're not. But in the group realm, there's three roles. There's the administrator, and the administrator is, like I said, handling the day-to-day, doing your annual testing, doing your hopefully they should be filing your 5500 for you as well. Most of the time, that's who's doing the 5500. Sometimes you can do it yourself. Sometimes your CPA does it for you if you're trying to. Yeah. But the administrator is the one who has all the information, and it's easiest for us to do the 5500. And then we're also doing hardship withdrawals, and we're doing the loan if someone wants to do a loan on a plan, and so on and so forth. So all these little nuances, there's so many things that go into it. That's who the administrator is. Then you have who is acting as the fiduciary investment. Who's holding the liability on the fiduciary, on the investment piece of it. So if you have employees, this is really, really smart, because you can't give advice to your employees. You don't want them coming to you and asking you which portfolio
right.
That is a huge amount of liability. You are not you're not their financial planner. They can ask their own financial planner to pick the funds that are in the menu lineup. So do you want to do that yourself? Do you want to outsource that to either a financial planner or a portfolio manager, whoever? And then the third and final is the custodian. And also known as record keeper is the lingo that we go by. And that's where the money's being held, right? If you have a 401k plan and your employees are asked by their neighbor who's your 401k with, they're not going to say us as the administrator. They're going to say Empower. They're going to say John Hancock. They're going to say Vanguard, Fidelity. That's where the money's being held. That's where your statements come from. That's where you log into, and that's who most of the time is tracking which is Roth, which is pre-tax, which is the match, which is the vested match, and that's why. And honestly, with these Roths coming into the simple IRA, last time I checked, they haven't even figured out how to track that yet.
Right.
Because they're so used to one or two categories inside of their software, they had to add 2 or 3 or 4 different more categories to see, okay, well now which is Roth? Now, okay, is this Roth vested? And they're tracking all this money. So that's the difference between a custodian and a record keeper, is how much information are they tracking?
Got it. Yeah. Record keepers will be holding the assets and keeping track of all the transactions. The administrator is keeping you compliant. And I talk about this all the time. Outsource the things that are not the highest and best use of your time. As a practice owner, we talk about it for bookkeeping. We talk about it for tax preparation. Please don't do your own taxes. And if we're talking about the additional headaches and complexity and potential liability with these retirement plans, that administrator is someone in your corner, on your side, helping you to deal with that liability and to keep you compliant. So that is
100%.
Someone that's in your corner, not just an expense. It's someone that is on your side, helping you do this right, helping you manage all this correctly. And so you've got these 3 different partners, I guess you can say. Sometimes they're bundled, right? They'll be all within one company. Sometimes they're separated out. Let's talk about some of the different changes that came up with the Secure Act, because I'd like to know more about these tax credits first of all, and how do these benefit practice owners looking to get their first retirement plan, and what are some of the other changes we've seen come up since the Secure Act? I think it was end of last year, right? Beginning of this year?
11th hour of December of 2022, right. And then a lot of these were implemented in 2023 on January 1st. So there's a lot that went on, and there's a lot on the personal side of things too that I won't touch on.
Yeah.
But some of the biggest ones, and I have a PDF I can share with you as well. But the tax credits are absolutely number one, and those went into effect immediately. If you have a plan in place prior to 2023, unfortunately you don't get those. If you didn't have a plan for 3 years prior to 2023, the 3-year mark is the point where you can requalify for those. But one of the biggest things that is, everything benefits to some degree. One, there's so many rules on when you can switch from a simple IRA to a 401k, right? You talked about that. You had to time it. Everyone had to be on board at the same time. You had to shut down, because you can't have more than one plan going at the same time. So you had to shut it down at a certain point, and then you had to reopen the 401k at a certain point. Now you can do it mid-year, which is phenomenal. It lightens the load on the pressures, because if you miss the ball, if you miss the target, then you had to wait another year before you do it. So it was such a dramatic experience.
I agree, because it was, if anyone's done this in the past, there was this fall deadline where you need to make sure you made a decision and started following through by this fall deadline so that it can start in January.
Yes.
Right. Just so it can start the next year. Fortunately, the Secure Act has sort of loosened that up, and now you can switch mid-year with some conditions, right? I think it has to be a safe harbor plan. Is that right?
Yeah, that's what we read. It's, again, lawyers everywhere are trying to figure out the ruling on this. I've also seen that you don't have to, as long as it. Okay. But for the most part, that's the purpose of moving. You want to max out the extra dollars in the safe harbor. So why it's 9 times out of 9, it's probably going to be a safe harbor anyway. So, but yeah, so that was a huge lift. Some other thing, just for 2023. They extended the RMDs so to age 75, which is more in the individual world. But when do you have to start making or pulling withdrawals out of your 401k if you retire? The Roth going into this is bizarre, and we're waiting on more information. We're waiting on more information. Waiting on more. That's what we get back all the time. But asking for Roth on the employer contributions.
Yeah.
The
So
employees
the
can
matches. Yeah.
match can be Roth, which is huge. And that went into effect immediately for 2023, which I love it for employees. I think it's phenomenal to have because prior to that, it had to be pre-tax. So you always had this two buckets. If you had a Roth and you always had the pre-tax bucket. So if you left, you had to roll them into two separate IRAs, and it was kind of cumbersome. So that's big for 2023. Moving on to 2024. For
that match,
sure.
it is taxable income to the employee, right? So it's not free. This isn't just a free switch. If you're choosing for that employer match to be in the Roth bucket rather than pre-tax, that amount is going to be taxable to you in that year. So just keep that in mind.
Yeah, 100%. Yeah, that's great. And that was part of our questions is how is that going to be taxed? So,
yeah.
And it on the employer side of it, it's another cost, a deducted cost. Yeah. So it's the employee does have to pay that in that current year.
And one more thing I'll add about switching plans mid-year is that if you're going to be do this starting next, when does that ability actually start? It's next year, right?
That's next year. That's 2024.
Mm-hmm. So if next year, in the middle of next year, you're going to be switching from that simple to the 401k, keep in mind you do need to track the maximum amounts that you're putting into these plans from one plan to another, because there's a maximum amount as an employee you can put in. Just making sure you're looking at both plans and taking both into account. But go ahead.
That's
sorry for interrupting you.
No, you're fine. That's part of the questions we're waiting. Like, what is the process to get to that point?
Yeah.
Who's tracking that? Who needs to do that? And at the end of the day, it's you have to track it yourself, but administrators help and CPAs help too. The other thing they're doing, this is interesting, they're implementing a starter 401k next year. It's called a starter 401k. And a starter 401k is, in essence, we do this quite a bit still. We call them payroll deducted IRAs. And basically what they're doing is a bunch of IRAs. The maximums are IRA maximum contributions, not 401k. There is no match. It's very simple to get started. It's just, again, another placeholder to get payroll deduction is the way we look at it. But the official starter 401k, some of these are going to be I think they're going to be, a lot of these are going to be government housed programs, but that's coming next year as well. There's so many little ones. Maybe we can have this on another episode too. They're emergency funds and things like that. But the tax credits are the biggest implementation for 2023.
Let's dive into that. Tell us a little bit more about that.
So number one, let's start with the ones that came through, the ones that are still here from the prior Secure 1.0 in 2019. So they still have a $500 contribution credit, flat contribution or a tax credit if you have an opt-out plan instead of an opt-in plan. So this is basically going to be a mandatory thing in 2025. For any plan starting in 2023 or beyond, all 401k plans have to be an opt-out plan starting in 2025.
Meaning that the employees, once they're eligible, will be automatically enrolled into the plan.
Correct.
They'll be contributing at a certain percentage into some defined automatic investment option. Correct. And they'll have to opt out of the plan if they don't want to contribute.
Yeah. They have to, instead of signing the form or filling out the form to opt in, they have to do it to opt out. In that QACA safe harbor has historically, that's what that's been for. Qualified automatic contribution arrangement. So that one always gave the $500 no matter what. You can now do that with any safe harbors or any traditional 401k as well. So that is still here. Then there's the administration credit. Okay, the administration credit, what did come through in the Security 1.0, but it only offset 50% of your out-of-pocket expenses for whether it's a record keeper costs or your administration costs. So it was basically $250 per employee, up to 50% of your costs. So if you had a $2,000 annual administration fee. Most would be $1,000. What they did is they increased that to 100%. So if you
Wow.
have, so it's $250 per non-highly compensated employee. And I want to go through an example here with you in a minute once we go through that. But so that's now 100%, which is huge. And then they have a contribution credit that was put in force. And this is the newest one, right? This was not in effect before. They're going to give $1,000 per year to any employee that earns less than $100,000, including the owners that pay themselves less than $100,000, $1,000 to offset the match, which is absolutely enormous.
So
Absolutely enormous.
a standard credit for the automatic enrollment. You have credits for non-highly compensated employees for startup costs up to 100%, right?
Mm-hmm.
And you have a credit offsetting your matching dollars as the practice owner.
Yep.
So we're talking about cost and complexity as reasons or excuses not to use the 401k plan. These credits, as if this is your first plan, this credit is helping substantially. Almost takes that
Absolutely.
off the table in a lot of situations, I'd imagine.
Yeah, it's mind-blowing, and we are able to design a net zero plan.
That's
and
crazy.
There's so many, obviously there's so many like nuances, like it's how many employees are coming in and stuff.
Yeah.
It's hard to do this with 2 employees, but
Yeah.
but if you have 10, 20 employees and you're just getting things started on the 401k side, it is absolutely possible to get these net zero plans. And I don't know if you remember what the maximum tax credit was prior to 2019, prior to Secure 1.0, was $500. That was
Total.
it for 3 years. That's it. That was it. So now I'm seeing absolutely five-digit tax credits coming
Interesting.
through. Yeah.
Wow.
Per year. So,
Wow. And for anyone who's not familiar, tax credit would be a dollar for dollar offset of your tax, right? So on your tax return, you'd see a dollar for dollar, essentially getting those costs back when you file taxes, but it's a dollar for dollar offset of your tax due.
yes.
So that's awesome.
And there's a lot of nuances in, like, who it's, as long as you have under 100 employees, you qualify. And and then if you go over the 50 employees, everything is, brings it down. So anyway, we have a calculator that we developed. So if you ever have a question,
I'll throw that in the
how
show
much,
notes. Yeah.
please. Yeah. It's instant, quick. So, but yeah, I wanted to go through a really quick case study before we ended. So let's just, and if you want me to, tweak this a little bit based on folks that you've worked with too, let me know. But so let's say we have a company that has 8 total employees, including the owner. Okay. 6 of those are going to participate. So maybe, so just 2 employees just decide that they don't want to do it, which is fine and absolutely normal. And then 5 of those 6 that participate are non-highly compensated employees. So that means one of those is the owner, one of those 6 is the owner, and the rest of the 5 are your employees, right? But let's just say every one of those 5 earn under $100,000. So you're paying all those 5 folks under $100,000 as a salary, right?
Got it.
And that part gets that $100,000 credit there. So total in years 1 and 2, you'll have $6,750 in tax credits for that company. In year 3, it's $5,500. In year 4, it's $2,500, and in year 5, it's $1,250.
Wow.
So the first 3 years, you'll see a total of $1,750 to offset your out-of-pocket expenses, right? Which absolutely is that could cover 100%. I'm looking at some record keepers right now that it's a net zero.
Yeah.
And then we have $5,000 to offset the match for the first 2 years, and then it dwindles by 25%. And then it goes down to 75% of that, then 50%, and then 25%. So in year 1, it's 6,750, and then year 2, 6,750, and then it just slowly goes down. So It's a little bit more than the 500 that you used to have.
Right,
So,
right. Just a little bit more. Yeah. And that's so helpful in new practices that are probably wary about, diverting a lot of cash into a plan. But if you're able to get these offset with these tax credits, that's so helpful. Unfortunately, if you are an established practice, you've had a simple IRA all along, unfortunately, you can't benefit from that. But you do want to evaluate these questions that Matt had talked about and ask yourself, okay, what is this plan actually doing for you in the business and also in your personal planning? And is it doing that to its best potential? I think a lot of cases after not very long, in my opinion, you're going to see that you're going to be ready for a 401k plan with more features, a larger opportunity to save. And yes, there's costs. There's other people you need to hire to help you with this, right? As people in your corner, but the long-term use of these plans are definitely going to be worth it over time. And if you are, let's say you're not a practice owner, you're an independent contractor, there's still opportunities for you as sort of a small business, right? A 1099 OD to use either a SEP IRA. I would even just go to the solo 401k. Mm-hmm. So you can even open up a 401k for yourself as a 1099 employee. Take advantage of a lot of these benefits, and there's even some additional benefits in after-tax dollars that you can use too that maybe a practice owner with employees probably wouldn't be able to benefit from as much. So if you're an independent contractor, look at your own options. That's a benefit of not being W-2 employed. There's trade-offs, but that's definitely a benefit there as well. Mm-hmm. Well, Matt, I appreciate all of your time here. Anything else that owners should know about these plans moving forward?
No, we covered quite a bit, and the biggest thing is just ask questions, yes. and there's ramp up time to build these things, to get these things going. Safe harbor 401ks have to be set up by 10/1 for the current year. So let's just, if you want to get a plan up and running before this year to get 2023 deductions, a safe harbor and a simple IRA has to be done by October 1st.
Got it.
And it takes about 45 days to 60 days to get it going. The record keepers, there's so many compliance. You have to put out a 30-day notice to your employees and so on and so forth. So there's a lot to it. So start now if you're thinking of getting something done for 2023.
Got it. Okay. Yeah, I appreciate that. And Matt, we'll put all of your information in the show notes. If you've got any questions, listener, reach out to me and Matt, and we can definitely help you get where you need to go. Stay tuned for next episode. Next week's episode, we will talk about, you've established this 401k plan. How do we build on top of it to really get the most and maximize these plans as much as possible? So we'll talk about profit sharing, cash balance plans. So we'll catch you on next week's episode. In the meantime, take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.